History has an interesting way of repeating itself, especially when greed, fear, and easy money are all involved together. Every new generation of investors tells themselves the same comforting lie, that this time, things will be different forever. Legendary investor Sir John Templeton once said those four words are the most expensive in the entire English language. He was right because blind optimism often empties a brokerage account faster than any market crash or sudden correction ever could. That simple truth brings us to a story almost everyone has forgotten, yet it's quietly starting to happen again today. A story of confidence, denial, collapse in the strange rhythm of history that keeps echoing through Wall Street every few decades. I'm talking about the forgotten Nifty 50 bubble of the early 1970s, a time of blind faith disguised as financial genius. But before that, we need to travel back to the late 1960s, when America believed prosperity was its permanent destiny. Factories were roaring, suburbs were spreading like wildfire, and the entire nation thought the good times would never end. People truly believed the United States was invincible, as if economic gravity simply didn't apply to them anymore. After all, America had defeated Germany, landed on the moon, and even invented the Etch-a-Sketch for children everywhere. From the end of World War II to 1970, the U.S. stock market climbed over 350% without a real pause. The world was drunk on optimism, and investors felt unstoppable, smarter, richer, and far more sophisticated than generations before. Out of that euphoria emerged a seductive new idea known as the one-decision stock, a promise of endless financial security. The concept sounded foolproof. Buy great companies once, never sell them, and let compounding make you rich for life. These weren't small startups or tech fads. They were giants like Coca-Cola, McDonald's, Xerox, and Polaroid, America's pride. Together, they formed the legendary Nifty 50, blue-chip icons seen as untouchable, timeless, and forever profitable. Investors treated them like gods of capitalism, immune to market cycles, recession, or even basic arithmetic reality. But here's the truth. If something sounds like a no-brainer investment, it's probably a grenade with the pin already pulled. By 1972, these Nifty 50 stocks weren't just overvalued. They were priced as if gravity had permanently retired from Wall Street. The average company in the market traded at 15 times earnings, a healthy, balanced, and historically normal valuation. Coca-Cola was selling for 46 times earnings, a number so high it could give an economist an instant nosebleed. Xerox traded at 49 times, McDonald's at 86, and Polaroid at a jaw-dropping 90 times its annual profits. Imagine paying $90 for every dollar a company earns. That's not optimism, that's pure financial delusion. On average, the Nifty 50 traded at 42 times earnings, nearly triple the market's long-term historical norm. To put that in perspective, it's like buying a hamburger today and expecting it to stay fresh for the next 50 years. Analysts told their clients these were forever stocks, investments so perfect you could safely hold them for generations. The media echoed the hype, writing glowing headlines that turned rational caution into full-blown market worship. At their peak, these 50 companies represented almost half of the entire U.S. stock market's total value. When half the market believes it can't lose, the crash only needs one small spark to burn everything down. Then came 1973, the year reality slapped investors across the face and reminded them math still matters. Oil prices suddenly quadrupled, inflation jumped to double digits, and unemployment began rising like a rocket. President Nixon ended the gold standard for good, and panic quietly started spreading through Wall Street's marble halls. Within months, the market collapsed 50%, erasing trillions in value and destroying years of blind confidence. Coca-Cola dropped more than 60%, McDonald's lost over 70%, and Polaroid crashed a staggering 90%. The one-decision stocks became one giant mistake, leaving investors shocked, broke, and utterly humiliated. And unlike modern crashes, this one didn't bounce back in months. It dragged on painfully for nearly 8 long years. Many investors never recovered, watching their savings rot away while pretending patience would fix the impossible. The Nifty 50 dream died slowly, teaching a generation that even legends can become lessons. But the real tragedy? Decades later, most people forgot that warning completely, until history began rhyming again. Because that same pattern, concentration, confidence, and collective amnesia, is unfolding once more right now. Fast forward to the 2020s, where a new cast of market heroes wears shinier logos but carries the same old storyline. Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia, the so-called Magnificent Seven of our modern era. Together, these seven companies now make up more than one-third of the entire S&P 500 index. Every dollar invested in an index fund quietly bets that these few giants will never stumble, falter, or fail. Sound familiar? It should, because that's exactly what investors said about the Nifty 50 half a century ago. The irony is striking. Different decade, different industry, but identical psychology driving the same financial dream. Yes, these companies are revolutionary. They dominate technology, reshape culture, and print unimaginable profits. But the market now values them as if innovation alone can repeal the laws of valuation and human behavior. Google trades at 28 times earnings, Apple at 37, and Microsoft at nearly 40, all defying gravity again. Nvidia trades at 50 times earnings, while Tesla's valuation soars beyond imagination at 247 times profits. Those numbers are breathtaking, not because they prove genius, but because they echo the same illusions investors once refused to question. The story always starts the same way: faith, excitement, and a belief that the rules of economics have somehow evolved. Every bubble begins as a love story between investors and the idea that tomorrow will always reward today's confidence. I once knew a trader named Evan who said Tesla stock would make him rich before he turned 30. For a while it worked. His account doubled, then tripled, and he felt like a market prophet who could never lose. But when the correction arrived, it was merciless. 70% of his gains vanished in 3 brutal weeks. The problem wasn't Tesla. It was the fantasy that prices only move upward because hope demands they should. That same fantasy drove investors in 1972 to believe blue-chip immortality was real, and it's driving markets again today. Human nature doesn't evolve as fast as technology. Our emotions still trade faster than our logic ever can. Every generation believes it's smarter, more disciplined, and immune to the mistakes of those who came before. But history has a way of humbling the overconfident, and the next chapter always rhymes with the last. You can see the pattern forming already: concentration, euphoria, denial, collapse, and finally, the silence that follows regret. In 1972, it was Polaroid and McDonald's. In 2024, it's Nvidia and Tesla. Same psychology, shinier packaging. Investors today call it innovation, just like investors 50 years ago called it industrial progress and global growth. Company. But behind both stories lies the same heartbeat: the collective fear of missing out on the next big thing. Greed whispers louder than caution, and that whisper turns into a roar when everyone starts making easy money. People stop asking questions, analysts stop doubting, and suddenly too expensive becomes too early to sell. Then one small shock, a policy shift, a bad quarter, an interest rate surprise, and the dream begins to crack. That's when investors remember, too late, that gravity never left Wall Street. It was only waiting for pride to rise. No. The Nifty 50 learned that lesson the hard way, and now the Magnificent Seven are dancing on the same fragile floor. Mark Twain once said, "History never repeats, but it rhymes." And right now, the market's rhyme is growing louder each day. The charts look eerily similar. The same steep climbs, the same concentration, the same confident headlines everywhere. If you remove the company names, you can barely tell 1972 apart from 2024. It's the same emotional fingerprint. Every investor believes they'll exit before the crash, yet almost no one ever does. Confidence is a powerful anesthetic. The truth is, markets are mirrors reflecting our collective emotions more than our collective intelligence. When fear fades, greed takes over. When greed peaks, humility returns, like gravity reclaiming its territory. Each generation builds a new tower of arrogance, convinced it's different, until the wind of reality arrives. What's happening today isn't new. It's simply the same story, told with better graphics and faster internet connections. The more things change, the more our psychology stays exactly the same, wrapped in new symbols of innovation. Even artificial intelligence, for all its brilliance, cannot outsmart human emotion, the most volatile force in finance. Investors say, "We've learned from history, but the data proves otherwise. We only repeat it with greater confidence." Markets don't punish intelligence, they punish arrogance disguised as wisdom, And right now, there's plenty of that. If the past is any guide, the next correction won't feel logical. It will feel personal, emotional, and completely unfair. That's the moment when denial fades, humility returns, and investors rediscover the value of discipline over excitement. True wisdom isn't predicting the crash. It's surviving it, learning from it, and remembering that it always comes again. Every generation must relearn the same painful truth. Markets rise on optimism and fall on overconfidence. I'm not predicting doom. I'm simply reminding you that numbers never lie, but people always do. Remember, valuation is not opinion, it's gravity, and gravity always wins, even when we pretend it doesn't exist. The next time someone tells you, this time it's different, pause, because that phrase has never aged well. It's the same melody sung before every collapse, only louder, faster, and with better sound design each generation. The market is whispering again, just like it did in 1972, daring us to believe history won't rhyme this time. But it will. It always does. Because human emotion never learns as quickly as human ambition. The lesson is simple. Stay skeptical when everyone else is euphoric and curious when everyone else is certain. Don't let temporary brilliance blind you to permanent truths. Gravity, discipline, and humility never go out of style. You don't need to time the market. You just need to remember it's cyclical, emotional, and deeply human. Ask yourself, are we seeing innovation or just another chapter in the endless book of collective overconfidence? Every investor must decide to follow the crowd into comfort or step aside and learn from history's warnings. The smartest people in finance aren't fortune tellers. They're historians who pay attention when others forget. They know discipline compounds faster than excitement, and humility outperforms hype over the long run. So maybe the real question isn't whether we'll crash, but whether we'll remember what we learned last time. Warren Buffett said, what we learn from history is that people don't learn from history. And he's right. The data, the charts, the stories, they all rhyme too perfectly to ignore any longer. Don't be the investor who believes gravity doesn't apply. Be the one who respects it before it strikes. Stay grounded, stay skeptical, and remember that curiosity is a safer investment than confidence ever will be. Because in the end, markets aren't about numbers. They're about people and the emotions they refuse to admit. Every bubble begins with a whisper, and every collapse begins when that whisper turns into applause. So listen closely. The whisper is back, and it sounds exactly like it did 50 years ago. Share this message with someone who still believes, deep down, that this time is truly different. Because it never is, history doesn't repeat. But right now, it's rhyming in perfect tune.